Okay, in the last video I talked about the different types of asset class. Second in the series is going to look at the two different styles of investing. One is indexing, the other is speculating, so let's have a look at those now. One school of thought says that it's extremely difficult to try to forecast all of the different equities, stocks and shares around the world that are going to work. We know we need to be there because that's the only area that we're going to get proper growth from to see us through 30 years in retirement, where we'll be able to live through rising living costs and so on and so forth. So the first school of thought says we're not going to try to forecast. So no forecasting, because nobody really can. Nobody ever sees any big global depression or 5-year economic cycle come along where markets depreciate by 20%, 25% for a few years before they recover. So it's not about forecasting at all. And it's certainly not about trading the portfolio an awful lot, because all of the data and evidence shows that if you just buy and hold, you'll do better than most active managers who are over on the other side. We'll talk about them in a moment. So it's about keeping trading to a real low, because every time we trade in these assets, it costs us money to do so. So trading's low. It's about having high levels of diversification. And by that, this school of thought says it's important to be in the UK equity market, the global equity market, and the emerging world equity markets. It's about being in a whole broad range of geographic locations. And not only that, it's about being in large cap companies, small cap companies, value companies, so a huge diversification. It's important to have that. That's this school of thought again. And in the same way that trading takes huge chunks, or can take huge chunks out of somebody's portfolio, be it a pension, ISA, whatever, it's also important to keep costs down as well. And that's one school of thought. On the other side of the pendulum, we have the speculators. Now, the speculators say, actually, it is about forecasting, because all we really want to do is hold all the really great securities and stocks and bonds that are going to work and avoid all the really bad ones that aren't. So it is about forecasting. And because it's about forecasting, the speculators also say that actually we're going to have to do quite a bit of trading, because we're going to have to get in and around all of these assets on a regular basis, and we're going to have to make it all work. So it's about keeping the portfolio traded on a very high basis. And where diversification comes into it, we're at the opposite end of the spectrum. The speculators would say diversification really is for just people who don't know what they're doing, who don't know what stocks and bonds to pick, and we do. So it's okay for us to have very low levels of diversification, and we might even just stick to UK or international. We might be very kind of focused in on particular areas. So it's about having a very low or much lower level of diversification. And again, it's okay to have high levels of costs built into your portfolio, because sometimes you've got to pay really clever people a lot of money to make all this work. And they're the two schools of thought. Having been around investment management now since, well, I joined Barclays in 1989. I was in the retail bank for 9 years. Then I joined Barclays Investment Management, Barclays Financial Planning. It's changed its names a few times since, but I was responsible for investing clients' money in the bank. I invested over £20 million between 1998 and 2002, just 4 years in particular. So I've been around it a long time, and I can tell you that my belief is that if you're over on this side of the pendulum, you'll have a successful investing experience. I'm not saying you won't over here, but all of the data and evidence and research from the University of London, Cass Business School, my own research, my brother's research, and indeed Vanguard and Dimensional Fund Advisors more recent studies come to mind. All of the evidence says that in 80% of cases, you'll be better off over there. keeping costs low and just sitting in for the ride, for the duration, as it were. The problem with the speculating side is every time they get it right, they've got to keep getting it right all the time. And it costs a lot of money. And that's what we'll come on to looking at now. So we're unapologetically over on this side. It doesn't mean we just sit there, and I'll talk in video 3 about how stock markets work and the different types of markets we invest in and why. So watch out for that one, that's up and coming. But just to give you some numbers here to demonstrate why it's so important. If you think about investment management, and this could be myself, my brother, it could be anyone, even a speculating manager, we typically charge 1% a year. On this side of the fence, you've also got investment funds, which can cost 1, 1.5, 1.75, sometimes even 2%. Then you've got product fees or custodian fees, which can be 0.3. And then you've got the trading fees. So FCA did a study not so long ago which suggested that they, in their opinion, trading an actively managed portfolio might add an additional 0.35%. The point of it all is, when you add all this up, you're at 1, 2, 3. It's not uncommon to be paying 3.5%, sometimes even 4%. I've seen people paying 4.5%, 4.75%. But I'm going to say over here, it could cost 3.5% on average. If you're with some glossy, expensive networks with, 1,500 really plush offices up and down the country who've got the advisor, like ourselves, they've got an area manager, they've got an area director, the area director reports into a board of directors, and the chain goes on. You've got to think, these people need paying really, which is why this sometimes exists the way it does, but these networks can charge 4.5%, 5%, sometimes even 6% as initial fees to bring you on board. You might not always see it, but they do. They might charge these expensive fees on an annual basis, and there can be expensive lock-ins too, so just be careful there. By comparison, if you're on the indexing side, you're looking really advisor fees at 1%, you're looking at funds, custodian, platform, you're coming in at about 1.5% a year. And I think you can carry that if you're in an equity portfolio which is doing north of 10%, which is beating inflation, which has been 5%. You've got 1% cost in there, you're still securing a decent return within your portfolio. But I think you can work the maths out. I mean, it's not going to be that way all the time in all cases if you're over on this side of the pendulum. Just to add another dimension to the chat we're having now on fees, the difference here is 2%. So let's just circle 2%. At last count, I read an IMA report, that's an Investment Managers Association report, which showed there was 5.7 trillion invested in the UK in our pensions, ISAs and so on and so forth, so 5.7 trillion. Huge amounts of money. 68% of that is actively managed according to the report over on this side. Now, that's about 4 trillion, isn't it? It's just under, but let's say 4 trillion for the broad sweep. I'm going to give them credit and say 20% works. So I'm going to say 3.2 trillion would have been better off over here. Okay. The 3.2 trillion is costing 2% more than it should do, in my opinion. So that's 64 billion pounds every year, which is going to high-cost investment management, high-cost investment managers, high-cost investment products and funds. That's a fact. 64 billion every year. Our mission is to start moving that 64 billion back over to its rightful owners on this side of the pendulum and encouraging more people to move towards our type of model. It's really important when you think that lots of people, huge numbers of people are going to be retiring at the age of 65, particularly baby boomers now. They're going to live through 3 decades of retirement from 65 or 60 to 90. Mortality rates have gone right up due to healthier living standards, better diets, huge advances in medical science over the last 30, 40, 50 years. And really, you have to look at it and think, are people going to be able to get through that window and live a great life where they will see living costs rise 3, 4, who knows, maybe 5 times even, and be able to do all the things they want to do and never run out of money? That's before leaving a legacy to any children or grandchildren. So this is really, really, really crucial and important, and we need to do something about that, and we're trying to do just that. 64 billion annual problem. It needs to go back over. That's my second video in this series. When we come back, we're going to be looking at how we invest in these markets and why. But just for now, there's a free template on martinwilcox.co.uk. That's my website. It's going to give you access to a pro forma calculator. Use it as a roadmap to contact your current provider or manager and drag this information out of them. You can also then calculate at the bottom what it's actually costing. I want to leave you with a final thought. If you've got £250,000 in your pension and you invested over a 30-year window, if you get a 5% net return, which as you can see is more than achievable, you'd end up with £1.16 million after the 30 years in your pension. If you dropped or lost 2% here, if you lost that 2%, your £250,000 pension fund would grow to £615,000. That's over £500,000 worth of difference. That's over £500,000 that could be sat in your pension in the future, which you could then live a great life with, or it could contribute towards your life. And if it's over here, it will be contributing towards a great life. It just won't be yours. It'll be the investment managers or the networks or the funds or the investment bank, whoever it is. Someone will be dining out on it. It just won't be you. So just think about that too. Go to my website, download the template, and that'll guide you to dragging out all the information you need. I'll see you in my next video.